Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, January 24th, 2024. It is 1:03 p.m. Eastern Time. I'm starting this video, so we're about halfway through the trading day. And here's what we're going to do in this one. I'll touch on the equity markets. We'll look at all the what I call major indexes, start there. Not really a deep dive. I do want to do a follow-up video and go over two things. I want to look at, which I've been reviewing, but I want to go over this in a video for you, breadth indicators. They're all pretty much telling me the same thing right now. We can even see a little of that here as I go over the indexes when I compare the equal weighted to the regular weighted. And what it is, basically, it's a return of the FANG trade, or the Bag 7, doing a lot of the heavy lifting. And again, that's evidenced in the charts when you compare those equal weighted and the non-equal weighted, or you look at various breadth indicators like the percentage stocks trading above or below their 250-day moving averages, advancing, declining issue ratios, all that good stuff. But we'll keep it relatively brief with a quick look at the indexes and some key levels to watch. Then we're going to roll into the other things, and we'll start with the big three. Well, stocks being one of the big three, so that's the indexes. The other parts are the big major currencies, the euro and the US dollar, that being Forex, and then Treasury bonds, or interest rates, if you will. And then, and again, not really a deep dive, just kind of overview on the charts where we're at. A lot of this is recapping. I've been covering these frequently. And then the end of the video, we'll have the other things, quote unquote, that I've been highlighting as trade ideas recently. And that is, those are various precious metals, certain commodities, and even Bitcoin. So it sounds like a lot, but I have it kind of mapped out in my head, and it shouldn't be that long of a video. All right, this is SPY, the S&P 500. This is my busy board, but what I can do is turn that off and just kind of draw it out for you here. So this is the previous high right here from the beginning of 2022, and that's where we're at now. So we're pretty much testing, if you will. Of course, the media will cheer a breakout to new highs, but for all intents and purposes, we're just there. And a couple things. Number one, we don't have any sell signals at this point in time. There's nothing in the charts that I see, trend line breaks, support level breaks. So, just going from a blank slate, I would say, whether you're short, long, whatever you're looking to do, the key levels based on the technicals, I feel very, very strong. There's still a big drop coming, and it based on the charts, it needs to be fairly, and again, relatively imminent relative to the time frame of these charts I'm looking at, the weekly and dailies, or the case is no longer there. And I'm not talking about overbought conditions, divergences. I know the same stuff I've been harping on for a while, but now since this period here, we have this divergence really starting to steepen. So we've had it building as the S&P went higher, and this is our divergence. Shows better on the weekly chart when you see it like that on the daily. Flip over to weekly, and you can see the big divergence here building, and that's where we're at. So, and if you're trading, longer term, or I always say for trend trading and longer term trading and investing, a weekly is probably the go-to time frame. It helps avoid whipsaws. So you want to see the weekly close of the candle. And we've got a slew of economic data tomorrow in the morning, and at 8:30 before the market opens, and then something at 10. We also have Tesla tonight. Here, let's take a look at that real quick, because when you're talking about trading the equity markets, you should always be cognizant of what's going on during earnings season. So this is tonight after the close. Tesla, IBM, ServiceNow, Lam Research, and then it goes down the line in order of importance. They put the big market movers up top. So that's it basically between now with a couple hours left to go in the trading session. And then tomorrow we're going to have a lot of potential market movers, and that can cut both ways. This is the weekly here. Let's go back to the daily and just look at the key levels. So again, a little bit of a busy board here, but there's that previous high, and we broke above it, and we're seeing these small, almost doji-like sticks on VTI, which I'll get to in a second. That's a very broad-based ETF. It's the total stock market ETF. They do have dojis. This is kind of quirky looking candles, not really what you see after a breakout. Again, it's a breakout that I would put not high, but very high odds on failing. And failing, this is again marginal new high. We're in fraction of a percent or so over that previous high from back in early 2022. But what you need to see to make the breakout fail, obviously, is going to be a move down this level right here. That's the trading range. We're consolidating. We broke to the upside. And as I like to say, a breakout is a breakout until less fails. So an objective short would be a solid move back down in there. It's actually pretty common to see breakouts, back test, but undercut the actual breakout level by a little bit. It's all about probabilities and how it is. So the way I would look at it is you'd want to see, maybe take a starter position there. Don't get married to it. And if you do short the breakout or any failure there of it, then you want to stop over that recent high. And that would be your first really objective short there. I'll have to get to QQQ and the others in a second. And again, take these collectively. I wouldn't, even if you want to trade SPY long or short, watch ES, the S&P 500 futures, watch QQQ, NQ, the other big large caps, to help confirm or maybe question any entry. But there it is. That's a pretty big, to me, an important trading range. As again, we broke to the upside, but everything I see in the charts indicate that breakout has again, very high chance of failing in the very near future. And I would say within a couple weeks, typically, and it could be days. We'll see. All right, so that's SPY. The levels, if you can't see them here, are about, I'm going to move that down a hair. It's about 478 on the top of the trading range, and then 466. You can see I put a yellow line here that I think I'm going to move it down just a hair, right about here. It's still at about 460. That, to me, I color-coded it yellow because I think that's very important. If and when that goes, which I suspect it will, that will be really make this whole breakout here, this whole period. Again, the breakout to new highs was right here, but it'll wipe out a lot of trading, pretty much all the trading through that trading range from December into January right there, and that'll be pretty bearish. And we'll also have taken out that previous high and that reaction high. We had a little consolidation there, and we popped it. There was the breakout above the that high. So those are your levels to watch. And again, 1, 2, 3, 1, 2, 3. And that should pretty much do the trick and start to roll over some long-term indicators, which again I'll get to at the time. But things like that on the weekly chart and maybe some of the shorter-term trend indicators on the daily chart. Okay, so there's SPY, the S&P 500. Here's RSP, the equal-weighted S&P 500 index. So that's if you cut out the overweighting or the extreme overweighting that the Mag 7 have, and then it shows you put an equal weight to all 500 stocks in the S&P, you're going to get this. And you can see we're still very, very much below that peak back in the beginning of 2021 right there. Even recently, this is interesting too. Look at the underperformance. We still haven't even taken out the top of that, the December to January trading range. In fact, we're in the lower end of it. So again, it's been just about all Mag 7 performance here. And remember, recently we got long Apple. Apple put in that divergent low, hit that oversold level on the daily chart, and I said, this is unwaveringly the most bullish, time, for Apple, the most objective time for an investor or a trend trader or swing trader to go long. Because of that. Again, it was not just the 60-minute chart, but this oversold reading is what I meant to say right there, and positive divergence on the 60-minute chart. And I highlighted this before. Each and every time Apple has gotten oversold, even in a bear market, you get a pretty nice lift. And so that's it. So this is right here, Apple being the big dog, right up there. Apple, Microsoft, neck to neck. You can see the impact that it's had on the markets. And again, when I do the next video, getting nitty gritty, lifting up the hood and looking at the engine, you'll see that that's confirmed because you have some pretty significant development. So again, on the breadth indicators I want to get to, but it'll just take too long. So let's now look at the next big cap index. So I showed you the equal weighted is significantly lagging. Here's QQQ. If you turn off all the lines, QQQ really isn't much of a, it is an index by definition, of course, it's 100 stocks, but it's, as I always say, probably one of the widely talked about and traded indexes, by far the least diversified, even much less diversified and representative of what's going on in the stock market than the Dow. And the Dow has been talked about for what, nearly 100 years now, or about that, at least that. And but yet Dow's 30 stocks, but it's diversified and it doesn't have such a overweighting to the top components as the NASDAQ 100. So there's the breakout. And it is, you can see, very impulsive because that's the Mag 7 doing that so far. So the levels that need to give way, just like the S&P, it's a breakout that I put high odds at failing. When you have very poor market breadth on breakouts like this and new highs in the market, that's typically a signature of a top. It has been in the past. We saw it in 07. We saw it at several points since then. So that's what we're looking at here. I'm going to add a line there. This is our most recent divergence line. It's really the same divergence it's been building since from here, right here to here. But you can see it's really steepening with this little kind of, this looks like a blow off top, potential buying climax. And you can see the divergence is even getting steeper. The slope is decreasing on the indicators right there. So there's our divergence been building, and that's that. However, breakouts to new high, or any breakout is a breakout, and bullish alongside breakout is bullish unless it fails. So where does it fail? Same level I've been showing you here, this trend line right here. This is the trend line that needs to get taken out. So you might want to set a price alert or just watch that one closely. There's the uptrend line with blows, forms this rising wedge, which also flows through on the 60-minute chart here. Remember, we had the last sell signal we had right there was at for a quick trade. We hit T1, then we hit T2 on the futures, which coincided with the uptrend line. This uptrend line right here on QQQ came in with the futures, and so that's when we covered shorts right there, and we went long for a bounce, including Apple in the markets. And this is just an extension of the same divergences that have been building, the same divergences that were in place here at that divergent high that gave us that drop have now just simply grown larger, therefore indicating a larger drop to come most likely. Now, sell signals on QQQ or objective entries. Well, other than this little gap up today, let me look at that. It leaves a potential for some type of island top. We'll see if we gap down tomorrow, if the economic numbers are bad or the market doesn't like what Tesla's selling tonight. You can see right there, this is today's trading on 60-minute candles. So watch that. You've got to love those island tops if you get them. They're not very common, but if you get one, that's one type of sell signal. So I always say sell signals and buy signals, they come on either breaks of support, resistance, above or below bullish or bearish technical chart patterns, but they can also come in the form of candlestick reversal patterns, such as topping in an uptrend. You want to look for topping patterns. And that would be an island top is one of them, and a bullish engulfing candle is another. You have these evening star dojis, you have all kinds of stuff. There's a gazillion of them out there, but again, something to watch for. But most importantly, guys, in my opinion, is this trend line right here. Let's color it up yellow or something so it stands out, make it thick. And that's the same one I showed you on the daily. If that breaks, keep in mind you do have the previous highs, depending on if and when it breaks. If it happened tomorrow or early next week, we'll also have taken out. This is a big level. You can see this is that sideways consolidation range. I talked about the December to January range right here. So we need to see that get taken out as well, which you'd get back into the range there under 413-ish. And then the bottom of the range, and that should be pretty much lights out if and when that happens down there, because we'll be well below that trend line. It'll help to confirm some of these things. Maybe things I'll be watching for. Bearish crossover on the PPO. This is the PPO on the weekly. Right now it's pointed up because the trend is up. And I like to see a bearish crossover to effectively put in a lower peak. And then that confirms this, what I call potential but unconfirmed negative divergence. So those are some of the things I'll be looking for there. Now, again, this is QQQ. That's a weekly chart. Go back to the daily here. Turn off all the lines. You can see QQQ at new highs. But when you look at the equal weighted index, not even close. Well, I mean, getting close, but still well off the highs right there. And again, that shows you that it's a handful of stocks. You look at the NASDAQ composite. Remember, the NASDAQ 100 is just simply the largest 100 companies within the NASDAQ composite. And the NASDAQ composite has a lot more. It's more representative of everything out there. And you can see also still very much off its previous highs. Also, big negative divergence. And at the rate it's going now, it just looks, at least at minimum like a near-term buying climax. That's what this looks like. When you have a strong run-up, a near vertical run-up, and you usually get that last gasp, right, like you had right there. Here, let me use a box tool right there. And then, boom, correction. So we traded that one down, covered there, went long right there. Everything hit support. Key levels on the big Mag 7 stocks, those purple lines I had, key support levels, and it was an objective time to cover that swing short and go long, which we did. And now this is very similar. You have that sharp move up right here, just like you had here. A little blip, one last thrust up, near vertical, and then the top was in. And you can look at the comments on the site. You could pull archives if you can find them on the internet. The whole world, media, most people, most folks were very bullish there and didn't want to short. Just like they got very bearish there and didn't want to go long. But the chart said to do otherwise. Okay, so the equal weighted indexes make it clear what's going on there. VTI is just a very diversified, total stock market ETF. It's really tracks the old Wilshire 5000. It's got small, mid, large caps, micro caps, and really it tracks the entire universe of the U.S. stock market. And so there it is. Big divergences as well, and same thing coming up, test that previous high. But again, we don't have any sell signals right now. I showed you where they would come from on the charts. However, whether you're long, short, let's look at the other things that are going to impact the stock market and the other investments. So next up is Euro US dollar, and this is what it's looking like. That recent thrust up we've had recently coincided with this. We had that divergent low. We hit that 108.334 support level I had here. Remember, we were bearish and short the euro off this divergent high, and that helped coincide with the pullbacks in the stock market and the gold and silver. More recently, we've been building divergence. So again, you can't make a screaming case to short right now. But what I'm noticing, we came off that divergence. We've had the divergence been building here, and the euro just can't get going. And it hit today. Again, these are all levels. You look at the previous videos. I haven't added any of these lines. This was a target before on the downside, target zone, and a resistance level. It's pretty good resistance, and we hit it to the button today and reversed. And so the euro is still up today, and that is net bullish for equities and gold, silver, and other things, and they are up. But it's actually faded quite a bit when you look on the 1 minute chart today. See, it hit that resistance level and it's come back down. Stocks right about as I started to do this video, we just turned in the market, and so it's starting to get the memo, but it didn't right away. So you can see here, stocks were going up. There's the peak. This is a 1 minute chart. QQQ peaked here at that says 12:56 p.m. But yet Euro USD. So this is what active traders could take. Peaked early in the morning, right at 9:30, right about the open, and started heading down. And so finally, stocks are getting the memo in this last thrust up that hey, the euro's not cooperating, and so we're seeing some of the gains faded in the rally today. Where we go from here, this is constructive. It would indicate that the euro is going to rally. and therefore we could see some more upside in the stock market. But I've been saying in the last few days, last week, actually for weeks now, and a while, or really forever, is me personally. I always try to diversify. Almost always. There are times where I've gone to cash and I come back into one thing or another. But at any point in time, especially in longer term accounts, diversification is just as important in active trading and swing trading as it is in investing. So we're going to get to the other things in a second here, the other asset classes. And everything, I believe, just about everything that I went over yesterday, the other long trade ideas, which I said could be used as indirect hedges of the stock market, they're all of them are up, and they're up more than even the NASDAQ. The NASDAQ is up a lot more than the S&P. Small caps are actually down. Threw that one out as a short the other day, and it still keeps running into that resistance. It looks like it wants to break out, but it hasn't, and I don't think it will. In fact, the breakout already failed. I'll get to that in a second. You know what? I have to go back. I'm sorry, I forgot. IWM is part of the indexes. I was trying to cover these in order. This is IWM. This is that massive trading range that we've had here, right here, all the way back from mid-2022 up until recently. There's that highlighted at the time. Breakout highlighted in advance that we were overbought, and all we needed is that bearish PPO crossover, which looked imminent at the time. And so I put in, at the time, I think I used the word extremely high probability that breakout would fail, which it has, because of everything here. We had the same exact setup, rally all the way into the top of the price channel, the sideways range, with overbought or extreme overbought conditions, followed by a high-level bearish PPO crossover. That's a lot of evidence right there. You usually don't get three almost perfect, zero failure rate when you look at these. Again, I went over this multiple times. And so it was good so far. Now the million-dollar question, will it stick? Or will something that's had a perfect track record for the last few years, again, overbought, followed by a high-level bearish PPO crossover, and in this case, throw in a rally to the top of the trading range. Nothing works forever. You need to be careful of that. Just because, I said it would have a high rate of failure, very high chance, and it did fail, doesn't mean that it can't go back up. So it's like anything. Don't get married to it. A lot of times when I realize a pattern, right about then is when the pattern stops working. So you need to know that happens sometimes. However, don't overthink it. It was 1, 2, 3 reasons to short the breakout there and fade it. And it was already a good trade in itself. And again, posted the other day, we rallied back to it. As long as IWM keeps running into that 199, I keep referring to it as 200. You want to give it a little room. That line's at 199. It's an objective short. It was the other day, and it still is. Nothing's changed there. And one of the reasons, I'm sorry, I said 3 reasons. 4 was the break of the trend line right there. So there were 4 high probability reasons to short IWM and to be short right now. So here I'm saying it as the market's at, the S&P is at all-time highs or near them. But again, everything I view in risk reward. I look at the RR ratio, probability, and as I said before this breakout even failed, that it probably would fail, and then when it does fail, the most likely outcome is a move down to the bottom. There's really 2 bottom ends of the range, that 1070 level right there. Sometimes that's held the rejections, but this is the true bottom of the range, 163. And from my experience, usually once you get rallied to the top of a trading range, especially if there's a false breakout, your next move is going to be the bottom of the range. And I said it the other day when we were right here, no, you don't short it now. If you didn't short here, you're probably going to bounce, because we already had a pretty good down, and that's the bounce. So point is, takeaway, we're still an objective short for IWM. There's that level on the 60-minute chart I think I got out to you the other day. About one. Remember, it's 199, call it 200 on the daily chart, which is right up here. So anywhere in there. And it's easy. To me, it's easy. Now, at this point, it already had a breakout, which failed. So it has no business to get back above that recent high. So it still remains, in a very objective stop level around 206 or whatever, especially if you're swinging for the bottom of the range or beyond. Now, with all that being said, when I did an update on IWM the other day, I said whether or not this happens or this is quite likely going to depend on what the large caps do. If the large caps continue to rally and start to continue to walk away from the recent breakout, the new highs, it's just going to bring enthusiasm and bullishness. Sometimes you will see the small caps doing this while the large caps do this, but usually it means a risk-on environment, especially what's going on now in large caps. It's not a broad-based rally. It's a very narrow rally with the big Mag 7 again in tech, and that means it's a risk-on market. So this is what I favor. I'm not being wishy-washy. I'm just telling you that's what would most likely foil this short trade. So to be clear and reiterate everything I just said, I can't make an objective case to short or add to or initiate any shorts on SPY or QQQ right now, but I can on IWM. It would be more of a hard short if I could make a strong case to short SPY and QQQ right now. And so if those breakouts do fail, then that would be where I would increase exposure to short on the small caps for a ride down to the bottom of the range. Okay, that covers everything, small, mid, and large. Well, I didn't do mid caps, but the small and large caps. Now let's talk bonds, TLT. Same thing. Like I said, we've been, for all intents and purposes, have hit that first target zone on the most recent short trade from up here. There's your sell signal. We had a divergent high, beautiful price channel breakdown, and we're hit again, effectively hit the top of the T1 zone. There's a gap right here. If you look, that's where I probably should have had the top of it, that line. But I'll just leave it there because that's what it was on the original trade. But I always say these are the actual support levels that are likely to produce a reaction. So you always want to cover here above. Right now we're at 93.37. The top of that zone was 93. So I can consider that effectively a hit. But let's talk more about it. So far, the treasuries have tried to rally. Again, this is the 30-year. I can't make a strong case that it will rally. I don't see a nice setup here. And again, I believe in my heart, well, I don't believe, I'm sorry, I should say, when I believe, it's just my opinion, I guess. I know for a fact this has been one of, if not the most overly bullish and heavily one-sided position trades in treasuries in years. Again, that goes back to some of the big brokerage firms that release their client holdings to the highest ever in TLT, moving into treasury bonds, and ever on record that they've recorded. And so we know, again, it was a trade we got in front of, and then we got out by the time everyone else wanted to get in. And that's why those things, those are usually the big trades. And where I'm going with that is if because it was such an overcrowded trade. Now, I have to caution this. Overcrowded can, and at times becomes even more overcrowded. All you have to do, if you weren't around at the time, read up on the dot-com bubble or just look at the NASDAQ going into the highs of March of 2000. So it made overbought just become more and more overbought. Bullish sentiment just got more and more extreme. And then finally, the bigger the bubble, the bigger it is the downside when it bursts. So this wasn't, I wouldn't call it more of the huge bond bubble. It was just from a kind of more of a trading perspective, that's where sentiment really spiked up. And anywho, so what happens then in those moves? Don't be surprised if treasuries just can't catch a bid because too many people went long. Everybody's long. When everybody's long, there's no one else left to buy. And again, I'm speaking metaphorically, not literally. And so that's why you can just see these things continue to drop. And as I've been talking about for a while now, do not underestimate, or at least I'm giving you my belief, my strong belief, that right now the market's chalked all this up to just a correction. Everyone knew bonds got one of the biggest runs in years, if not decades. Got a little ahead of themselves. So I think even the bulls were looking for a healthy pullback. But from here on down, again, I'm looking at IEF now, the 10-year bond ETF. I think this is where the market will become increasingly sensitive to rise in rates. Remember, this is pullback in bond prices. So if they continue lower, that means rates are going up. And this is a very likely target, I believe, for IEF, the 10-year. So it's only halfway there right now. And so if we do see that, again, I can't make right now, I don't have a strong opinion. I can't make a strong, I'm not making any I don't make recommendations. I share my analysis. You guys decide what to do. But I can just tell you right now that I can't make a case to go long or short IEF. There was a case to be made up here on that wedge break, and for all the other reasons we shorted TLT, we got a little more bang for a buck out of TLT. Remember, that's usually recommended. It's a double position size. I think we were in here a hair early, but either way, this has already fallen 7%. So if you double up on the position size, which I like to do at least for Treasury bonds because of their inherently low volatility, you're targeting smaller percentage gains and smaller percentage losses versus equity trades. So, that makes it about a 15% drop so far, beta adjusted, just like we had, getting in long at the lows, which was also recommended a double position size. T4 was hit right here. That was 16%. So that's about a 32% trade right there on the upside. All right, so the takeaway is watch Treasuries, watch the Euro. I wish I had a stronger opinion on both right now. I'm seeing a little bit of, on the 30-year, we've got some little bit of divergence, but we had some forming there and it never panned out right there. See right if I draw these lines. And so, as I often say, but it seems that it falls on deaf ears based on a lot of the comments on the site, divergence, whether it's bullish or bearish, is not a buy signal. It is not a sell signal, just like overbought or oversold is not a buy signal. It's not a sell signal. It can be used in conjunction with other metrics, as I showed you earlier with IWM, but there were three or four other reasons to short IWM on the overbought reading, but the overbought reading in itself was not the sole reason. Okay, so same thing there. Let's see what's up next. Let's just hit the rest of us now, trades, I'll call it. So just for reference, the stock market is up. S&P 500 is up 0.56%. QQQ is up 1.2. And IWM, the only objective short highlighted recently, is down. But it's right where we shorted it the other day, so it's not a win trade. However, the other things out there, silver is always, I always state and have recently, is my preferred proxy when I'm bullish on gold and the metals. And it's up 1.5% today, coming off the most recent divergent low. So by far offsetting any losses on any index shorts right now. The other ones I mentioned, I liked platinum and palladium recently off these divergent lows in support. Platinum, not much, but up 0.28%. Palladium is up 1.9%, a lot more than the stock market today. Still coming off that divergent low. What else was there? Wheat yesterday highlighted breaking out on ZW wheat futures as well as WEAT here, coming off that divergent low, still above that last suggested stop right here from back there. And we keep hitting T1. Again, same story. Big trading range. This one, unlike IWM, which I think in buy and everything else, it goes to the downside. I think ultimately we break to the upside. But until and unless we do, I can't make a super strong, long-term call on it. That is my analysis. That is my outlook. It hasn't wavered. I've just recognized that we've been in this, multi-month trading range. And the top of the range being well defined, which is also T1. So, you can consider it one trade from back here that's still in play, or various, trades if you recycle in as a more active trader. But again, that's a big level when that six-ish level's taken out. So it's also up 1.75%. So a diversified portfolio containing both commodities, equities if you have them, and precious metals is more than offsetting any equity shorts right now. And if you're long equities, you could have took these as well, because I made the case there were indirect hedges that if the euro goes up, if things go up, well, these were on their own chart. These aren't really dependent on the euro as much. Metals, yes, but not so much the agriculture commodities. So the other one is Bitcoin. I'm using futures, but GBTC is the ETF for you ETF folks, and that one is also up today. Pulled back a little bit, but it's still up 1.7, much more than the stock market is today. So those are the alt investments or other things out there, and so they're all firing on all cylinders today. And of course, one day doesn't make a trend, but it just it does show that sometimes you can have those indirect hedges, and if positioned right, all your trades can actually work out. In other words, they don't have to just offset a loss one for one. So that's it. I promised it wouldn't be a super long video, and we're right about where I wanted to cap it, hair over. And again, I will follow up for those interested and do a more detailed video with covering all the various breadth indicators. There's a lot out there that I like to watch. We'll maybe even look at some of the sentiment indicators, but that's it. So the charts to me, again, the divergences continue to build, the overbought conditions. The charts tell me that that not only are the breakouts likely to fail, but when they do, it has very, very much has the potential to mark a major top. And then that one thing I wanted to just loop back to, I don't know that's how my brain works. I forgot to mention there's those, look at these little dojis lately in VTI. On declining volume on the breakout as well. There's just no follow-through buyers. And maybe they're waiting to see. We've got earnings season coming up, so it could be, anything's possible. But again, you have the levels to watch. It's really these trading ranges here. Enter those, and it's not the end of the world. But if you go down to the bottom of the trading ranges and then break below, that's where I think things will get pretty ugly for the market. And if you're bullish, look, if you're bullish, and I know quite a few have jumped over to that side lately, buy a breakout. Take it on face value. Like I say, a breakout is a breakout unless it fails. Just like I told you 2 weeks ago, this is the hands down the best opportunity I've seen in a while to buy Apple. Go long based on everything I showed you earlier. The overbought conditions on the daily, the bullish divergences on the 60-minute chart. That's where you bought it. And if you bought Apple, even and you held it because, like I said, you may have a different outlook on the market in Apple than I do. We gamed it up. It only hit, it's just a little bit above that maximum bounce target zone. But in just, what is that, a couple weeks, this thing's up almost 10%. That's swing trading. If you're happy with your 10%, take profits, or what I like to do is set stops and let it run. I like to put stops strategically. Strategically now would be below the first decent support level, which is the bottom of the second target zone. So that gives it a little room if it wants to pull back. However, if you are bearish, I can't make a case to short it right now. I made a case right here. I thought it would fail at T2 zone. It didn't. And so now that has to fail. I have to see it come back a little below there. And that's where I could make an objective case to short it. And the weekly chart's been singing the same song to me for a long time. Massive divergences. I know a lot of folks are saying, they don't work anymore. And this is my weekly chart. And I've gone over this so many times, but I don't know, people, I don't know, maybe they see things different from me. Divergent high there, 32% drop. Divergent high, 21% drop. Divergent high, 35. I know you might not be able to see all the numbers. Divergent high, 39%. Divergent high, 32, and at the time I suspected more. I made a post on the site. Before all said and done, it was almost a year-long drop, 34%. So this is a third of the market cap, 40%, a third of it. This was a 45% drop off that divergent high. The stock got almost in half. Back here was a 62% drop, and so that's it. And, in one day, if this market continues to power higher in 2014, I have to keep lifting these lines. And then at some point, I no longer have the divergence, especially if we worked off the overbought conditions. Hey, then I don't have a case to say that Apple is probably going to drop, from almost $200 all the way down to my next targets here. It'll be about a 46% drop. Actually, my next target down here on this weekly is right there. And that's about a 40% drop down here to the 120-ish level. Then ultimately, it's that current final target's uptrend, 82 and or the primary uptrend line. So when I say and or, that was back here when the bear market started. And so now you can see they would have come in together had it been, something like this. Now the trend line comes in first, the primary uptrend line. So and by the time we get there, it's going to be somewhere out here, most likely. So therefore, kind of takes 82 off the table, at least for the time being. I may add that back later. So yeah, we're looking probably about a 40% drop. Once these divergences begin to play out and we get some decent sell signals. Oh, and then I'll leave it here. There's a purple uptrend line as well, right there. And we need that to get taken out. That would be a big sell signal. And again, I'll do it in another video. All these purple lines that I covered on the Mag 7 way back here, why we went long the market, covered all the shorts when Apple and just about all of them hit those major key support levels. This is where the odds that that whole bear market, much more downside to come scenario plays out, as I've been saying, increase substantially. They will go shoot up from wherever they are now to probably, I'd put them, probably 80-90% chance that we're going to hit those longer term bear market targets. But we're quite a way above there right now. So Apple's got a lot of room to even get down to break that those lower purple lines right there. And so until then, again, this is big picture stuff. You don't have to be positioned for that. You can if you want. You're just going to have to be patient, because this is what Apple's been doing for the last, what is that? For months now. All right, I'm still talking. I'm going to wrap it up here, guys, get the video out to you, and we'll see where we close today and what Tesla does to the market tonight and some of the others. And then really tomorrow, like I said, lot of heavy economic calendar. So hang in there, and just whatever you do, I can't tell you what to do, but if you go home heavy, long or short into today, as a swing trader, I like futures because I can get my stop hit or my profit target hit at 3 in the morning, or if something happens and the futures explode or implode at 8:30 tomorrow when the economic data comes out, then I can be stopped out immediately, which you can't do on individual stocks and ETFs. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.